Hey, it's Stuart. Choosing the right super fund is an incredibly important decision. And towards the end of July, early August each year, I produce an episode reviewing the top 8 industry super funds. This year, I'm going to add Vanguard into the mix. And I think that information can help listeners, work out which super fund might be the most appropriate for their needs. But that's only sort of part of the problem or the question. The big thing is then to work out how to invest your money. So what investment option should you take? And that's what I want to talk about today. So normally super funds have pre-mixed investment options. So high growth, balanced, conservative, these sorts of names. Sometimes they have life cycle investment options. So if you were born in the 70s or 80s or 90s, this is what your asset allocation should look like. And then you can be a little bit more bespoke in regards to asset allocation and decide how much you want to put into Australian share market and how much in the international share market and so on and so forth. The theory behind asset allocation is really about growth assets versus defensive assets. And the two key considerations here are your risk tolerance. So if you have a high risk tolerance means that you can stomach volatility. You should probably invest more of your balance into growth assets like share markets, property, these sorts of things, private equity, emerging markets. They're the sorts of things that are going to have higher volatility, but also higher returns over the long run. If you don't have the stomach for higher volatility, then you want more defensive assets, bonds, cash, fixed interest, these sorts of things. Risk tolerance is one consideration. The other consideration is investment time horizon. So how close are you to retiring? Because if you're in your 20s, well, you can't access super for about 40 years. I'd argue you've got a very long time horizon. Short-term volatility shouldn't worry you. It's all about maximizing returns over the next 40 years. Whereas if you're 2 years away from retirement, of course, you don't want to suffer a 30% drop in your super balance. So in that regard, capital preservation starts to become more important than investment returns. The challenge, however, in Australia is that there is no set definition. There's no set definition for high growth versus balanced. And that can be challenging and problematic. For example, Hostplus's balanced investment option has 76% invested in growth assets, which is pretty high for a balanced option, whereas balanced at Vanguard is about 50%. So we're talking about ostensibly same product names, if you like, but completely different products. So you can't trust what the product is named or the investment option's name is. In fact, I've noticed over the last 5 to 10 years that super funds try to make their products look a little bit more aggressive in order to capture greater investment returns. So for example, Hostplus has the highest allocation to growth assets in its balance fund to make its balance fund look as attractive as possible. It can then say, look, compared to everyone else's balanced, we've beaten them, we've produced higher returns. But they've only produced higher returns because they've got a completely different asset allocation. Well, maybe not completely, but a more aggressive asset allocation. Whereas, and quite often Hostplus and ART, Australian Retirement Trust, which is a old Queensland industry fund, they often advertise that, they're the highest returning funds. But actually, when you compare apples with apples and you look at, for example, Australian market performance or international share market performance, they're not the top performers. So you can see that there's a bit of window dressing going on behind the scenes just to make them look better. Look, I would argue in terms of choosing an investment option that maximising long-term returns is far more important than minimising volatility. Particularly for super, particularly because as Australians, we tend to have a long time horizon. And I'd argue, unless you've got a lot of surplus assets, that is way more money than you ever need, I'd argue even in retirement, long-term returns are still important, because if I've got a finite pool of money and I hope that I'm going to live in retirement for 30, maybe even 40 years, running out of money, which is longevity risk, is kind of my key issue. So I wrote a blog and recorded a podcast episode last year suggesting that perhaps we should all be invested 100% in equities, that any defensive assets inside super probably don't necessarily play a big role, because we know that there's overwhelming evidence that those defensive assets are not going to perform as well over very long periods of time compared to growth assets. And I'll include the link to that episode in the description in this blog, so if you want to sort of check that out. So really what I'm saying here is that I think a higher allocation towards growth assets is probably going to suit most people, particularly if they're keen to maximize long-term returns. And then what I would say is, if you are concerned about volatility, then just stop looking at your super balance, which is not ignore your super. You still want to make sure, is it the right fund? Is it the right investment option? But once you've done that, just let time do its thing and let returns sort of come through over time. Look, some common mistakes that I see, I just wanted to talk about them as well. Common mistakes, people trying to premix their own options. So they might put 50% in growth and 50% in balanced. And I guess the thesis behind that approach is that neither really suited, I'm neither growth nor balance, so I want to be somewhere in between. But I'm not really sure that you can measure your risk tolerance to that level of accuracy that's going to be correct. And I think you're probably better off just let the super fund, which has really got an investment committee, they spend a lot of time talking about asset allocation, let them do their thing, let them work it out. I think that's a better approach. The other approaches I've seen is when you go too bespoke. So you might go, look, I'm going to put 40% in the Australian share market, 60% in the international share market, and so I'm all growth, but only in those two developed markets. Look, that could work longer term. It's not terrible, but you then have no exposure to infrastructure, property, emerging markets, private equity, these sorts of sub-asset classes, if you like. Again, I just think the best approach is just leave it with the experts and let them manage the asset allocation. So one of our preferred super funds, UniSuper, its high growth investment option is invested 100% in growth. So if you're after 100% in growth, that's a good option. And then they will professionally manage the asset allocation in terms of, how much in developed international markets, how much in emerging markets, how much hedging, all those sorts of questions. Let the experts do their thing. The other observation, the final observation I want to share with you, is some industry super funds allow a DIY approach. Often it's called members direct or something like that, that allows members to go and buy either direct stocks on the share market or ETFs and allows them to invest their own money like that. Look, if you are confident that you can achieve better returns than the investment managers, and you're confident in your abilities and you've got a good track record, that could suit you. But if you're not, again, you're just probably better off to leave it, almost certainly better off to leave it to the investment experts. So no mix and matching. I think try to, depending on your risk tolerance and time horizon, try to have as much growth in your super fund as possible. And certainly if you're in your 20s and 30s, I think there's an argument to be made that you should be all growth, and then just leave it to the investment managers to make that decision. But choosing the right super investment option is a really critical decision. And if you get it wrong, you're going to leave returns on the table, and you don't want to be looking back in 20, 30, 40 years time from now going, I wish I took more risk. Anyway, that's the upcoming episode in my podcast this week. So I'll delve into a little bit more detail during that episode, but I just wanted to record this video to kind of share my thoughts. I hope that's useful. Cheers.